Good morning. This is part of peer tutorial program of UNC-JPIA. For today's topic: Callable preference share, Redeemable preference share, Convertible preference share. Before anything else, I am using Financial Accounting Volume 1 2019 edition by Valix Peralta Valix as a reference.
Callable preference share gives right to the issuer to call for redemption of the said share. That is why it is an equity instrument rather than financial liability. The issuer is the one who sold the share to a holder who is a buyer of the said share. For it to become a financial liability, the holder must have the right to require the issuer such share like redeemable preference share. Before the illustration, preference share is always indicated in articles of incorporation or OIE with a PAR value. In absence of specification of shares in OIE, it may be concluded that shares of the corporation are ordinary shares. You will learn the regulations on corporation more in your business laws and regulations subject. As you can see, the preference share capital is always valued at a PAR. Any excess over the PAR is credited to share premium or additional paid in capital of same class of share, which is preference share. At original issuance, shares may not be exchanged for a value lesser than the PAR or stated value. For example, an entity issued 10,000 shares with PAR value of 200 to another entity for a land with fair value of 1 million. The illegality of the action commences when the issuing entity issued the share certificate to the buyer of the share and record the issuance in the journal entry. This is called watered share. As you can see, the shares are called by the issuer for redemption, which at 1,500. By redeeming the shares, preference share capital is debited with a value of 1 million, and any excess is charged first to share premium from original issuance of the share, in which at this case is 200, and any remaining balance is charged to retained earnings.
Redeemable preference share is one which has a mandatory redemption date or one which must be redeemed at the option of the holder. Based on the definition, redeemable preference share is a financial liability in substance, although it is an equity instrument in legal form. Let us apply the law in this matter. Redeemable preference share may be redeemed regardless of presence of unrestricted retained earnings to support the cost of redemption, unlike treasury shares, which there must be sufficient unrestricted retained earnings to support the cost of reacquisition. This fact alone conclude that redeemable preference share in its substance is a financial liability because it is partly performing a creditor role. However, according to General Registry No. 51765 Republic Planters Bank vs. Agana Sr., redemption may not be made when corporation is insolvent, or such redemption will cause insolvency to the corporation. Simply said, for one instrument to be qualified as equity, there must be no contractual obligation to deliver cash or another asset. In the illustration, the implicit interest rate is applied by multiplying the carrying amount of preference share by the rate. Any income that the holder of such share may yield is recorded as loss on the part of the issuer. It is a financial liability, therefore, any proceeds or distribution made to such holder is recognized in profit or loss or the income statement rather in the retained earnings. It is because retained earning is an equity, therefore, any proceeds or distribution made to equity holder is recognized in retained earnings, but with consideration first to share premium whenever applicable. Since the application of interest is compounded annually, the interest in the prior year is added to the carrying amount of preference share in the computation of the interest in the current year. The formula given will enable you to determine the future amount of the preference share. Be careful on using the formula. Identify the period of life of preference share before redemption with caution, as it may produce different amount. For example, the share is issued on January 1, 2020 and the redemption is on December 31, 2023, therefore, the period is 3 years. At the redemption date, the difference between redemption price and carrying amount is recognized in profit or loss. The carrying amount is the sum of issuance price plus the interest credited to the share.
A convertible preference shareholder may convert the preference share into ordinary share because the operations are successful and earnings on ordinary share are unlimited. He may also convert the preference share into bonds, which is an debt instrument. The result is change of equity from that of owner to that of a creditor. Simply said, by converting the preference share into bonds, the holder will become a creditor, shall be subject to every rights enjoyed by a creditor. However, convertible preference shares are normally converted into ordinary share. Convertible preference share is still an equity instrument because it does not carry a contractual obligation to deliver cash or other assets. Based on the illustration, the preference share is converted into 3 ordinary share. The holder will now have 30,000 ordinary share by multiplying the 10,000 preference share by 3. The share premium related to preference share is cancelled. The ordinary shares of 30,000 is multiplied by the PAR value of 30 to determine the total cost of ordinary shares from conversion. Any excess of preference share and the cancelled share premium over the total cost of ordinary shares is credited to share premium related to ordinary share. While on the case 2, the preference share is converted into 5 ordinary shares. By doing the same procedure, the ordinary shares from conversion will have a total cost of 1,500. The excess of cost of ordinary share over the preference share is charged first to share premium related to preference share and the remaining will be charged to retained earnings. In this case, no share premium related to ordinary shares is credited because the cost of ordinary shares from conversion is more than the cost of the preference share converted.
That will be all for now. The next topics are share-based payments, donations, and assessment, and recapitalization. Goodbye.